Hi, everybody. It's Alison over at Homeowners Financial, and this is part 3 of the credit class. We're talking about basics, nuances, and COVID-19 because that's still a thing that's had a lot of impact on our world, on the financial industry, on your life. And so this segment, I'm really digging into nuances. I really want to tell you what this means from an impact for your perspective of bills we can't pay, how do we handle things, different things moving on in the future. Now, this is something that is kind of changing. We will see guidelines update in the future. But again, my intent is to share as much as I can with you so that you are empowered to be able to make the right financial decision for you and your family. Thank you for watching this. Please subscribe to get more. We're going to push out content every single week, again, so you can peek behind the curtain and really find out what's going on. All right, I'm going to share some screenage. Let's do this. Okie dokie. All right. So again, we are talking about these nuances. We're talking about credit basics, nuances, and COVID-19. Now, the basics and nuances are already on this channel. Those were previously done. But, I like to say that a good financial plan is a roadmap that shows us exactly how our choices we make today will affect our future. So this, again, is evolving as we speak. Now, one of the things I'm going to get to in the next slide, but I want to make sure you know that credit guidelines are a double basis. There is the federal regulations. There's the Real Estate Settlement Procedures Act, the Fair Credit Reporting Act, the Equal Credit Opportunity Act. There's these federal regulations, and then there's servicing guidelines, the people that actually service your debt, and then there's investor guidelines, the people that'll actually lend you the money. So it's this regulated world and this private party world, and what we're looking at right now is the difference of forbearance is not forgiveness. So a lot of servicers immediately put people into forbearance. I have some clients that own restaurants. They're like, Austin, they just told me I don't have to pay. And I was like, did you tell them yes? And they're like, no, I can pay. I was like, well, you should pay. It's better for your credit, right? That forbearance can impact the way you qualify in the future. Forbearance is saying you're going to pause your mortgage for 3 months and then you're going to pay it all the way back in that 3 months. Okay. Modification says, hey, I need to change my payment level over time. I no longer can afford the payment level. Got to change in my income, change in people who pay the loan. Maybe there's a death in family, something like that. And then deferment says, hey, not only can I not pay it for these next period of time, but I need you to add it to the end of the loan. So I'm going to stretch it out. I'm going to defer that pain. So there's forbearance where you pause for 90-day, modifications where you change everything, ideally for a lower payment, and then deferment where you're tacking it on the back end. Now, here's the thing. You have to apply for this technically. I did mention just before that there are some servicers that kick people into forbearance. They weren't supposed to do that. They were some of the bigger banks. Yay, big banks, not a thing. But you do need to apply for this. It's not automatically assumed. And I'm seeing a lot of people that as they come out, they're like, hey, I'm an esthetician and I did do the forbearance, but I can catch up now. I want to get caught up, and they're having trouble getting a hold of servicing. So this is something that you're going to have to be in deep communication with the people that service your loan. Now, let's talk about student loans real quick. So student loans, a lot of folks were, hey, you don't have to pay. Now, two things. Remember in the first class, we talked about balance to limit ratio. So if you're deferring the interest on your loan, your balance is increasing. So your balance to limit may look like it's over 100%, and that can hurt your credit score. So when we qualify you for a loan, we're still gonna have to include that student loan payment. Even if you're a teacher or in the nonprofit world where you're looking at it being forgiven over time, you are responsible for that debt because, again, it's not guaranteed. It has to be applied for, and we always have to take a worst case scenario. Let's talk about 4506T executed with transcripts waived. What that means in English is that right now there was a lot of delay for people to be able to file their tax returns, especially if you were self-employed. The state of California, their rules came out a lot later than the federal and how they're going to treat PPP. So if your tax returns have been filed, you should be able to get these transcripts. So we verify that the tax returns we have on file are the same with the IRS with what's called a transcript. It's a 4506T. That is the transcript. That's what the T stands for. That's just the form number. Don't know why it is. It's just a thing. So for me personally, I filed my tax returns before they were due in April, and our tax refund just hit in June. Right? So that is like a 6 to 12 month delay we're seeing. And so we can see that if proof of filings happen, if you owe money, you might have to show that you've paid it. If you received, it might show that it's pending and it's in process. But they're not necessarily going to always need that full transcript because we know that there's a lot of delays. Now let's look about this and why is credit relevant to what your income is. Now here's the deal, it's always your debt to income ratio, right? You remember that from the ABCs of lending class, or if you don't remember it, watch them. They're on this YouTube channel. And so we're just gonna verify that the income is still recurring. Like we had a guy that we got to the end, and he's like, oh yeah, no, they fired me yesterday. I'm like, you're buying a house, man. You should have told me. Let's pause. Let's talk about this, right? We're gonna re-verify things. If you're self-employed, we have to confirm that you're still open for business, right? Online re-verification. If your business shows that it's closed online, this is a problem, right? And if you own other properties, we got to reconfirm that you're not in forbearance because servicing is different. Because again, forbearance is not forgiveness, and there's different from a credit standpoint to qualify. One thing I want to key into, and this is going to go in the next slide, which is no one's going to read this in 5 seconds, but I'm going to give you exactly what it says. The Fair Credit Reporting Act that says what you're allowed to report on people, if it's positive, if it's negative, things like that. You know, they moved it back to 2020 of last year. They moved it back to said, hey, if you have issues because of COVID-19, that data can be paused, right? We're not necessarily going to count it against you. So this is the actual section of the act that changed. That's a really big deal. There's like a 30-year-old act that changed. So I want to make sure you know that it's not just automatically forgiven if we had problems, but to make sure we're in communication about it. So what we learned today really is that COVID-19 has changed from a federal standpoint, from a servicing standpoint, from an investor standpoint of how credit is given and how it's judged. I'm not supposed to say judged, but that's really what it is, like how it's judged, how it's qualified. So if you have any questions on how this impacts you, please let me know. I am so grateful. Thank you so much for spending the time today. I'm Austin at Homeowners Financial, and if there's anything I can do to help you or anyone else, please let me know and make it a great day. Bye.